All right, welcome to Talk Tickers. We're jumping right into Eaton's Q3 earnings today. And this one's a real head scratcher. You've got what looks like a fantastic quarter on the surface. We're talking record margins, really solid growth. But then the stock takes a nosedive. So what gives? Let's get into it. Yep, the stock finished the day down 2.3%. It really is a classic Wall Street story, isn't it? It's this tug of war between amazing operational results on one side and on the other, a surprisingly cautious look ahead. So let's unpack what the market was really paying attention to. Okay, so here's our game plan. We'll hit the results versus the street, check out management's big AI pivot, figure out why the stock dropped, and then wrap it all up with our take on what's next.
All right, let's dive right in. Section 1, the ticker, Eaton Q3.
Okay, so let's talk results versus the street. This is where it starts to get interesting. We've got a beat, a miss, and some real operational strength under the hood. It's a mixed bag for sure, but mostly positive, which, just makes that stock drop even more curious. So, on the bottom line, Eaton posted an adjusted EPS of $3.07. That's a beat, but just barely. It edged out the consensus of around $3.05. Revenue, though, that's a different story. It came in at $7 billion, which was a narrow miss against what the street was looking for. And that's even with a pretty solid 10% growth year over year. But here's where the story gets really good. You have to look under the hood. The company put up record segment margins of 25%. That's up 70 basis points from last year. I mean, that is just a sign of incredible operational execution and some serious pricing power. And that amazing execution, it turned right into cash, a lot of it. We're talking a record $1.2 billion in free cash flow for the quarter. You just can't argue with that. It shows how efficient they are and, well, proves this is a really healthy cash-generating machine. Now, if you're wondering about demand, just look at this, the backlog. I mean, it tells the whole story. Their electrical sector backlog shot up 18% year over year. Aerospace, up 15%. And look, this isn't about what they did last quarter. This is about what they're going to do. This gives them incredible visibility into future revenue. It's already locked in. Okay, so you've got this massive demand building up. So what's the long-term play? Well, this is where it gets really exciting. Management is making a huge pivot, going all in on the AI boom with what they're calling their chip-to-grid strategy. Yeah, the CEO, Paulo Ruiz, he really spelled it out on the call. He said, with the acquisition of Boyd, Eaton now plays a leading position in each one of those technology blocks, from the chip to the grid. And that's the whole vision right there. They want to be the one-stop shop for data centers, handling everything from the silicon itself all the way to the utility pole. And the absolute centerpiece of this whole plan is their massive $9.5 billion deal to buy Boyd Thermal. Now, Boyd is a huge player in liquid cooling, which is absolutely essential for these super powerful AI chips. We're talking about a market that's expected to grow something like 35% a year. It's just explosive. This Boyd acquisition, it's really like the final piece of the puzzle for them. It lets them offer this totally integrated solution for data centers. So, step 1, they can cool the chip itself with Boyd's tech. Step 2, they handle all the power inside the server room, what's called the white space. Then, step 3, they manage the infrastructure connecting out to the grid, the gray space. And finally, step 4, the grid connection itself. It's the whole shebang from start to finish. Okay, so the numbers are strong. The AI strategy sounds incredible. So what gives? Why did the stock drop? This is really the heart of the matter, the big disconnect we saw on earnings day. And this right here, this really lays out the whole battle. On one side, you have the bulls. They're looking at the record margins, the huge AI backlog, that strategic Boyd deal. They're looking at the future. But on the other side, you have the bears, and they're focused squarely on the here and now. They see that tiny revenue miss, the weak Q4 guidance, and some softness in their vehicle and e-mobility segments. On this day, the bears won. The market basically said, yeah, the future looks great, but we're worried about right now. So all of this brings us to our favorite part, the next call. Let's put all the pieces together and figure out what this means for the stock from here. So the big question you have to ask yourself as an investor is this. Is the market right to be nervous? Is this sell-off a red flag? Or is this a classic case of Wall Street getting caught up in short-term noise, completely missing the massive long-term transformation that's happening?
While we think it's absolutely the latter, the market is missing the forest for the trees here. That's why we're initiating our take on Eaton with an outperform rating.
Okay, so here's our thesis, nice and simple. The market totally overreacted to a conservative Q4 guide, and that's created a really attractive entry point. What's the catalyst? Well, we think it's the next earnings report. We believe that huge electrical backlog is going to drive a big beat, and that's going to open some eyes. So our prediction is that the stock is going to re-rate higher once the market finally starts to price in this whole chip-to-grid AI story and the power of that Boyd acquisition. Plain and simple, we're giving it an outperform.
And as always, just a reminder that this is not financial advice.